you only need to own 7 stocks. Bear in mind that there are considerable periods of time when it's much better to be invested in smaller companies than the very large companies. And this 10-year period to 2016 that we've highlighted shows you a classic example. Over the 10 years to 2016, being equally weighted, that is to say, favoring smaller companies at the expense of larger companies, paid off quite considerably, the red line being the equal weighted and the green line being the cap weighted. That shifted around the COVID period so that we can now see how the green line, the S&P market cap weighted return, has been greater than the equal weighted return. Generally speaking, when you get to such stretched levels, it is time to go back at the equal weighted or to smaller company exposures. And that's what we've been doing in the Global Equity Trust. Arguably too early. We have exposure to Microsoft, we have exposure to Alphabet, but we have tried to avoid the paying up a lot for the likes of Meta and paying up a lot for the likes of Amazon and Netflix. We prefer other stuff. Again, just to point out that even if the earnings follow in these expensive companies, it doesn't necessarily mean that the share price will outperform. The 1999 equivalent of NVIDIA was Cisco. Cisco was priced at 100 times earnings, if not 40, 50 times revenues. And despite the fact that Cisco's earnings have caught up, the left-hand side, with the rating as was then, the share price is actually not yet back to where it was in 2000. So that gives you an idea that even if the earnings do come through, once the stock gets to be very, very expensive, the share price doesn't necessarily have to follow. So the stock buybacks program was running at about $1 trillion. That has benefited shareholders. But again, if you're going to invest back in the business, then share buybacks are going to have to be reduced because that money that's spent buying shares back will actually go back into capital investment instead. The Biden administration did introduce a buyback tax of about 1%, but we can see a situation in which companies are incentivized with threats and or taxes to invest in capital. It strikes us as mad, for example, that Intel spent so many years buying back its shares rather than investing in its fab business. And it's now gone back to the taxpayers and the government under the CHIPS Act and is going to be publicly money subsidized to invest in expanding and increasing its R&D in the fabs in the USA, when in fact, of course, it should have been doing that with its own money. So the capital investment theme in the USA is going to benefit the likes of foreign companies such as TSMC, that's actually already broken ground in a second fab in the USA. Hitachi, because of its expertise in providing nuclear power. I'll touch on that a little bit later on. VW, I've mentioned, they have made plans to close 3 factories out of their 10 in Germany because of costs of doing business. BYD, Build Your Dreams, the Chinese car company, electric vehicle company, are they going to be allowed to set up in the USA? Perhaps they will. Essentially, these are going to be friend-shoring events, but they will mean that companies that have been relying on share buybacks to boost the shares might not necessarily see such a tailwind. You're going to have to look at things like revenue growth and strategic positioning much more than expecting financial engineering.